What's up you guys, it's Michael here, and in this video I'm going to go over the best ways you can invest $10,000 as an Aussie in 2020 in order to really make the most out of it, because $10,000 is a sizable amount for anyone, which could actually end up making a significant amount of difference in the long term as long as you don't mess it up. So it's so important you actually just find a way to utilize this money correctly. Even just finding a way to get an additional 2% return on that $10,000. After 30 years, that $10,000 would actually be worth $8,100. And I'm pretty sure if you watch this video until the very end, you will find a way to maximize that $10,000 to try get at least an extra 2%. So in a weird kind of way, just watching this video could actually end up making you an extra $8,000. And all I ask in return is for you to smash that like button and comment for the YouTube algorithm, because that really helps push the video to a new audience who can then actually hit that like button and comment for the YouTube algorithm as well. So with that said, let's get into it and let's go through the best way for you to invest $10,000 in Australia in 2020. So first, let's start with one of the most boring, basic, practical and safest options for the $10,000, and that would be the emergency fund. Now, for those who don't actually know, an emergency fund is really just the money that you set aside to only be used in case of, you guessed it, an emergency, where you have no other place to turn. And ideally, the size of this emergency fund is usually around sort of 3 to 6 months worth of living expenses, and kept easily accessible, so very liquid for obviously emergencies. Now, having this fund of 3 to 6 months for emergencies really means you're not going to have to rely on credit cards to pay your way through any unexpected events. And you won't have to sell your stocks or other investments at a time when maybe they've actually declined in value and it's not really the time you want to sell them. And you also won't have to take on any high interest rate debt if anything happens. So in a way, having this money on the sidelines, keeping it there ready, is actually going to save you money in the long run. So it's actually almost acting like a little insurance policy if something was to happen unexpectedly. So if you don't already have an emergency fund, then using some or all of the $10,000 towards building that up would be definitely one of my biggest recommendations to start with. Now, ideally, an emergency fund is something you want to keep completely liquid and available at any time you need it, and kept very safe so it doesn't fluctuate up and down in price. Because if there is an emergency, you want to make sure you have that $10,000, not $8,000. So really the best place for this is a high interest rate savings account. Recently, I've actually been using Zinja, one of these sort of new neobanks, to get myself that sweet, sweet interest. But to be completely honest, it doesn't really matter where you have it, as long as you're getting at least a competitive rate of around 1.5% at least. And there's a whole bunch of banks that fit this criteria. The main reason I'm using Zinja besides another bank is because I actually normally keep my money in ING as my transaction account. And I prefer to have my emergency fund in a separate fund that's not sort of as easy to access, so I don't sort of get tempted to use it. And separately, it's actually a nice account because you actually get the maximum interest rate on the savings account without actually having to do anything. So no like 5 transactions, no depositing $2,000 a month. You just get the maximum interest rate no matter what. So it's really perfect for my needs for an emergency fund account. So I'm sure someone at least is thinking, why don't I just take that money and invest it somewhere else? I could get a way better return than 2%, like in the stock market. And certainly you could go ahead and do that, but my rationale is really that typically emergencies happen on short notice when you most need the money. And if a recession happens and you lose your job, by the time you need your money, your investments have gone down 20% in value. Then I have a feeling that at the time you would have wished you had just kept your money in a high interest rate savings account. Then once you've built up that 3 to 6 month buffer in that emergency fund, we can go to the next step, which is another rather unexciting, but could be a profitable way to invest that $10,000, is to actually pay down any high interest rate debt that you have. Now, obviously, if you're in debt, whether it be a credit card debt, a mortgage, an auto loan, a personal loan, doesn't matter. If you're in debt, that debt is costing you money. Now, of course, some debt is good debt. If, for example, it's really low interest and that debt is helping you make more money, then sometimes it actually makes sense to keep the debt and just reinvest the money elsewhere. But if you have high interest rate debt that isn't making you money, like a car loan, for example, then that is debt that needs to be paid down as soon as humanly possible. And here's my reasoning with that one. When you invest your money in a broad index fund or in real estate, your investments on average will return sort of 6 to 12% on your money. And to get that type of return, you're going to be risking some years in which you'll actually end up losing money, whereas others you will make a bit more money. So again, if you just compare it to, stocks or something where you're going to get 6 to 12% on your money, debt doesn't really sound too exciting. But the problem is there's going to be some years in the stock market where you're going to be losing 6 to 12%. Whereas when you're paying down this high interest rate debt of 8, 10%, for example, you're getting a guaranteed return on that money no matter what, at whatever interest rate the debt is. So say your debt is at 10% or 20% for a credit card. If you pay that down, you are literally getting a 20% return on your money, which is incredible, with no risk whatsoever. So here's my basic rule of thumb. If you're paying above 5% interest rates, then it's probably best you just throw as much money as possible at that debt to pay it down as quickly as possible, because you're going to get a similar return as to whatever good investment you would generate anyway, especially after sort of paying taxes on it. So for the way I see it, there's really no downside at all in paying off high interest rate debt. So you may as well just go ahead and do it. If this applies to you and you have any high interest rate debt, then I would use that $10,000 and put that towards the highest interest rate loan you have first, and then work your way down from there if you have more loans. Consider that a risk-free, guaranteed return on your $10,000 and a really, really good use of your money. And then after that, we can move on to the next steps. So the third step is where things start to get a little bit more fun. Once you've set up all your emergency funds and you've paid down all of these high interest rate debts you have, now you can actually use that $10,000 and potentially invest in your retirement fund, your superannuation account, to actually set you up for the long term. There's some really awesome tax benefits that apply to superannuation, which make it really something to consider, especially for anyone that's sort of closer to retirement, but really it's great value and great sort of tax benefits for anyone. So making an extra tax deductible super contribution is a great way to get maximum sort of bang for your buck. Yes, that's right. You can actually boost your super and get a tax deduction to sweeten the deal. But as with everything to do with super, there are rules and limits to the government's generosity. So listen up and I'll tell you sort of what the deal is. So for starters, you can't claim any tax deductions on any super contributions by your employer. So that 9.5% that they'll do for sort of out of their compulsory requirements, you won't be able to get anything back for that. And this applies to any reportable contributions above this amount that's happening directly through your employer. So salary sacrificing extra into super, you won't be able to get a tax deduction on that either. Tax deductible super contributions have to come from your after-tax income. This income may come from a variety of sources. It could be from your job, it could be from a side hustle, it could be from the 20 bucks your nana gave you. Whatever the source, you can make a payment to your super fund from your bank account, either as a one-off payment or a periodic direct debit. These contributions count towards your concessional contributions cap, which is currently $25,000 a year. Concessional contributions are taxed at the concessional super rate of 15%. And it only applies for people who have incomes of less than $250,000. So it's basically free profit for anyone whose marginal tax rate is above 15%, which will be most people who have an average sort of job. And you know how much I love free profit. So for example, if you're earning $80,000 a year, you would already be getting compulsory superannuation payments from your employer of about $12,000 a year, which means you could contribute an extra $13,000 a year before reaching the concessional cap of $25,000. And if you put that entire $10,000 you'd saved up towards contributing to your super, then after $1,500 of the 15% contributions tax that we talked about, then you would be left with a net contribution to your super of $8,500. But then you can actually claim a tax deduction of $10,000 on your next tax return, which would reduce your taxable income to $70,000 from $80,000, and your marginal tax rate would be 34.5%, which actually means you would pay $3,450 less in tax. And then keeping in mind that you've already paid the $1,500 on that contribution tax of 15%, your instant net profit would be $1,950. However, since your super is guaranteed for the long term, it's extremely important that you set it up properly. Check out my video on high growth superannuation options if you haven't already, as it does sort of go over some great options to provide you with long-term high growth superannuation. Assuming you're already way ahead of the curve, you have your emergency fund, you've already paid off all your debts, and you do contribute to your superannuation every year, Now here's what I would do with $10,000 if you're actually saving up for a larger investment or don't want to take on a whole lot of risk. And that would be either using sort of a term deposit or a high interest rate savings account or a bond ETF. Now this one might actually seem a little bit counterintuitive because after all, the entire point of this video was to find a way to maximize your investments, but sometimes you actually want to save up for something that's going to cost you more than $10,000, like buying real estate, for example, or investing in a business, or even just putting your money somewhere else that's just going to require more than you have right now. That's where this strategy and this option comes into play. It's low risk, low reward, but it's safe and steady, it's consistent, and you could continue saving knowing that your $10,000 is not going anywhere and it will keep going up, but just not as quickly as, say, YOLOing into stocks. First, a high interest rate savings account is probably the most obvious choice, and there's really no shortage of high interest rate savings accounts these days. Just make sure you've got one that's getting you at least 1.5% per annum return on your money. And there's a lot of options out there, so I'm not going to go into them, but I will link a few of them down in the description below. But secondly, if you know for sure you're not going to be needing that money, at least for a little while, and you need to save up for a certain amount of time that you actually kind of have a good idea about, then you could actually look into putting your money into a term deposit, which usually gives you a slightly higher return than a savings account. A term deposit is basically like a type of savings account that will give you a fixed rate return for a fixed period of time, which is anywhere usually from a few months to a few years. So the return is guaranteed and stable, and they're usually higher than the return in a savings account since you have less liquidity. However, we're actually in a very strange economic environment at the moment where term deposit returns are actually less than the returns on high interest rate savings accounts. This basically means that banks sort of foresee interest rates to either really remain steady or potentially even go lower than what they are now, which is why they aren't willing to provide a higher return for a term deposit for fixing your money in for 2 years, for example. So depending on when you're actually watching this video, a term deposit might not actually be better than a savings account, but there is one benefit, which is if you don't actually have a lot of self-control, it stops you from accessing that money, so it is a good option for that. And third, if you want to take on a little bit more risk with your money, but you also want to kind of play it safe at the same time, then you also have bonds. A bond is basically like an IOU from a government, and for the most part, a bond is an extremely safe investment because it's super unlikely a government is going to default on that IOU. So for example, we've got the Vanguard Australian Bond Index Fund ETF, VGB, that has paid around 5% per annum over the long term after all fees. But let me make this clear that bonds are not a risk-free investment and they're not a risk-free return because the value of that bond and that IOU that we talked about can go down because the value of that bond could actually go down over time and hence the payout and return could be going down as well. But you could also end up making a little bit more money as well. But for someone who's willing to take slightly more risk in exchange for a slightly higher payout, then this might be a decent option today. Nonetheless, any one of those 3 investments that we just went through would be a great way to spend $10,000 in the event you really want to keep your investments safe and don't want to risk it while you're saving up for something a bit larger for the future. Okay, now let's assume that you actually want to do something big with your $10,000. You want to make some moves and turn it into a small fortune in the future, but you also don't want to be stupid with it either. If that's the case and that sounds like you, then you have index funds. An index fund is just basically something that tracks the overall market and you'll be able to own a small amount of everything for just one low cost. And since index funds actually track that whole market and not just one specific stock, it ends up giving you a lot more diversification and a lot more sort of consistent growth over that long term. And historically, on average, one of the most popular index funds in Australia is VDHG, has actually produced a return of about 8% return over the long term. And for most people watching this video, I would actually recommend this route. It's probably got the best sort of risk versus reward in terms of how much money you're going to be able to make. Not only that, but index funds are extremely low fee, which means more money back into your pocket and not into some fund manager's pocket. The reason is because index funds are actually really easy to create and put together, and they're not actively managed, like I said. So there isn't a lot of overhead and those savings just get passed directly back to you. The other big advantage of doing this is that most individual investors will end up making way more money through investing long-term through index funds than they will by investing in individual stocks on their own. Several studies have actually suggested that around 92 to 95% of portfolio managers, these are professionals, couldn't even outperform the stock market themselves over 15 years or over any long period of time. So if they can't beat it, it's really unlikely you're going to be able to beat it. And the third advantage of going this route and going with index funds is that diversification that I talked about. Even if you own sort of 10 or 15 individual stocks within your portfolio and you think that's pretty diversified, if one of them does really poorly, you could actually end up losing a lot of money. Whereas on the other hand, with an index fund that's buying into a broad market, that's going to have sort of thousands of companies, if one of them goes down, you don't even notice it. Lastly, the final advantage of index funds is that it's just easy. You don't need to spend hours of time trading and thinking of which companies to buy and analyzing financial reports. You don't need to wait and time the market and try to sell at the very top of the market, for example. All you really need to do is just jump onto your brokerage app and click a few buttons and buy a total market index fund ETF. And that's really it, and you're done. So for anyone who wants to know some great index funds to invest in other than VDHG, check out my video on 8 alternatives to VDHG, where I go through a bunch of different options at varying sort of different risk levels. So you should be able to find one that's suitable for you. If index funds are just a little bit too boring for you and you want to take on a bit more risk for a potentially higher return, you could use that $10,000 and invest it in individual stocks. So this one is by far the riskiest of any of the investments I've mentioned in this video, but it could also potentially be the highest return. This is because you're actually placing all of your money within a few specific companies, or even just one, for example, and your entire investment is really just dependent on how those companies do. So if you've got a knack for picking stocks and you're not trading emotionally, then this could actually end up working out really well for you. I personally recommend, if you're going to be doing this and going down this route, make sure you're at least using a low-cost broker, so you aren't losing a ton of money through brokerage fees. There's obviously tons of brokers available, and I'll link a couple of low-cost options in the description box below. So using these stock trading platforms, you can trade stocks that you choose, and the returns you can get trading individual stocks are really going to outpace anything you'd get in an index fund if you actually pick them correctly. For example, Afterpay alone just this year is up over 50%. But remember to keep in mind that this is also significantly riskier, and for every company that's doubled in price, there's 10 that have probably gone completely bankrupt. But if you do have an interest in learning the stock market and learning how to trade, and you don't constantly check stock prices and it keeps you up all night and you're losing sleep over it, then maybe picking individual stocks could work out really well for you. So finally, $10,000 is actually potentially enough money to get involved in real estate investing, depending on the price point in the area that you're sort of looking at, as well as what type of place you're looking to get as well. Now, of course, realistically, chances are if $10,000 is all you have to your name and that's it, you're probably not going to be investing in real estate with it. There's just so many additional expenses that could come up from this, and there's so many things that could go wrong out of nowhere. So it's so important you already have that cash buffer, that emergency fund in place to hold you over in case something like that ever happens. But if you have $10,000 to use specifically towards a down payment, that means you could potentially buy a property of around, $100,000 or $200,000, depending on the type of loan you're getting. And then you could rent that property out and then make some more money in that way as well. So the big advantage of real estate investment is that you get to borrow most of the money needed to invest. And this means you could leverage your money and potentially control a $100,000 investment for only $10,000. And then you get to keep all the profits the property generates. So for example, if your property in a year goes up by 10%, you've actually made a 100% return on your $10,000. And there you go, you've instantly doubled your money because that's how math works. In addition to that, like I said, you could go out and rent the property and you could get a few $100s a month, which would boost your return even further. Not to mention all the sort of tax benefits you get associated with owning a property. You get to depreciate the property, write off any expenses, building equity in the property, and you also get to see property appreciate over time. So obviously the big downside here is that real estate investing can be risky. And as we're starting to see right now, real estate doesn't always go up in price and can actually go down as well. And obviously the barrier to entry is a lot higher. You need a decent amount of money to get started, and then you also need decent income to support that mortgage. So you're gonna have to be very careful about which property that you buy. And then finally, it's actually an actively managed investment. It's very different to ETFs, for example, which means you're gonna have to take a lot of time and put in a lot of work. But if real estate is your thing and you actually get a lot of control over this type of investment, and you also get a lot of tax advantages from doing so as well, which can end up making a lot of money in the process. So there you have it. Those would be my top ways to invest $10,000 for Aussies in 2020. Really, the option for you just depends on the sort of risk that you want to take on and what sort of point you are in your investment journey. But I guarantee that one of these ways is going to help you maximize the return on your money when you have it, so that you can actually turn that into something way bigger in the future, and so you could smash that like button for the YouTube algorithm. So with that said, guys, thank you so much for watching the video. I really do appreciate it. If you're not subscribed already, please subscribe, and otherwise I'll see you in the next video.